then let's get started. Can you see my screen?
Perfect.
Wonderful. Welcome to today's afternoon online panel discussion. Excited to be here with you discussing secure infrastructure for digital assets. Today, joining me is Philipp Sandner as the moderator from the Frankfurt School Blockchain Center, Seamus from METACO, Peter from Custodigit, Josh from Curv, and Lior, founder of GK8. They will each introduce themselves shortly after this initial introduction from my side. The second step of which is the chat. So for those of you who've been to our events before, we have the online discussion parallel to the panel discussion, where you can ask your questions to the speakers in this WhatsApp group. So just scan the QR code now to join, or go back to your email program. In the link you receive with a Zoom link, there's also a WhatsApp link. You could just click on it. It will bring you into the right group and you can post all your questions there. Myself and Philipp as the moderator will check that group for additional questions, and depending on how it fits the time constraints of this event and also the topic, we will bring these questions into the discussion as well. I'm also looking forward to have the speakers in there so that we can continue the discussion even after the event is over. So that's it from my side, from the Disrupt side. I'll now hand over to Philipp.
Thank you very much. I think it's a very fascinating topic to now more and more tackle the structure, the infrastructure to really become professional. I think we have some key companies here who are exactly doing this. For example, METACO running or having supplied in the past infrastructure for German exchanges. I think we can say this, right? You have to tell this yourself. Then we have GK8 running the infrastructure for eToro. I hope this can be said, and a couple of others. So I think it's fascinating to now not just have very brand new technology startups here, but rather let's call it like the legacy companies of the custody business, if we can say this, growing and recently being funded. And therefore, I would directly like to hand over to the first speaker to quickly present himself. And then we are going like speaker by speaker, such that everybody can quickly present himself and present his quick view of what they are doing. And you see here, we have companies here which might also be competitors here and there, but in case we will dig a little bit deeper, then we will easily find out that the technological solutions are slightly different here and there, such that sometimes they appear as competitors, but they are not. So we have companies here as follows: METACO, Custodigit, both sitting in Switzerland. Then Curv, as far as I know, they are sitting in Israel, and the same is true for GK8. So let's start with Seamus from METACO. Maybe you would like to quickly present yourself and maybe also a couple of words about your company.
Sure. Hi, Seamus Donoghue. As mentioned, I'm in Switzerland, responsible for sales and business development at METACO. METACO is a technology company. We're a software company. We work with primarily large banks and financial institutions to help them integrate digital assets. So we have, as Philipp mentioned, we work with a number of licensed custodians. We're the trusted technology partner for a number of BaFin regulated custodians. Same with FINMA, increasingly Western Europe and Singapore, and hopefully in the near future with some of the changes in the US as well. So.
Okay, thanks. That was a very brief statement. We will elaborate on your perspective on the industry later on. Okay, then next I would propose Peter Hoffmann from Custodigit to quickly present himself.
Hi everybody, my name is Peter Hoffmann. I'm CEO of Custodigit, right? Custodigit is a spin-off company of Swisscom, the biggest telecommunication provider here in Switzerland. Custodigit is providing a bank-in-a-box platform to regulated financial service provider who actually want to provide cryptocurrencies as well as digital asset services to the end customers. So we see ourselves as a core banking platform for cryptocurrency and digital asset, and we provide all the end-to-end business functionality a financial institution is needing. So pretty much Custodigit has done all the heavy lifting for the financial institutions. And as you mentioned before, we are also not brand new. We are live in the market with our first customer, Signum Bank. Signum Bank is a challenger bank focusing on digital assets here in Switzerland since August 2019 already.
Okay, that was also very brief summary. So we have two Swiss companies here. Next would be Josh Schwartz from Curv.
Hey guys, so Josh Schwartz, I'm the COO of Curv. It's a background on Curv. We provide security and market infrastructure for many of the largest institutions in the space, both across crypto native and traditional, including many of the largest exchanges, eToro, Corbett, Bitso, et cetera, many of the trading firms, custodians, which I'm sure we'll talk about today, and traditional firms. We've been public about our work with firms like Franklin Templeton. All these clients are using Curv to both securely store and transact within digital assets. Our security model is based on MPC, or multi-party computation, which completely eliminates the need to ever create or use a single private key, which, as we know, has been a single point of failure in the space and has resulted in billions of dollars of either lost or compromised funds over time, which I'm sure we can talk about later on the call. One point of clarification, I think similar to everyone here, we ourselves are not a custodian. We're a technology provider. We offer technology so that our clients can custody their own assets. And we're working with many regulated custodians globally, both within the US already, several BaFin regulated custodians, and are now working with other firms around Europe and APAC. So happy to be here. Thanks for having us.
Excellent. Thank you. And then finally, we have Lior Lamesh from GK8. Also very happy to have you here. And also please present yourself and your company quickly.
Thank you, Philip. I'm very honored to be here today. So I'm the co-founder and CEO of GK8. I earned my stripes in one of the toughest neighborhoods in the world for cybersecurity, in the Israeli Prime Minister's office. I was part of an elite team that protected the strategic assets of the country from cybersecurity attacks. We were trained to protect from state-level hackers that are willing to invest millions to steal billions. This is exactly the approach that we bring into the company. Our intro to this space was very interesting. While 2 years ago, we encountered for the first time in a solution that people claim to think that it's the state of the art in the market. And actually, we found a way to hack it in 4 days. And what we realized was there are not real cold storage in the market. And the reason is that they are all connected to the internet at some point. Then what we do is we try to think if could it be optional to make a fully operational system for banks to manage blockchain-based assets without being connected to the internet at all. And we ended up doing exactly that. So we are providing banks with end-to-end on-premise solution so they can offer a custody service for their clients. Our clients already manage over $1 billion in digital assets. As you said before, eToro is indeed one of our anchor clients, but of course, not only them. Likewise, we are also providing the solution, not the service for custody. This is something very important to emphasize, same thing like Josh. Yeah, I'm very honored to be here. Thank you.
Excellent. Thank you for the presentation. You said 1 billion, right? Not 1 million.
1 billion. That's right.
That's right. Under custody. Okay, great to have you all here. So let's start with a basic question about the market. So how do you feel the market is currently working or operating? You know, we are talking about cryptocurrencies. Do you see an increasing interest? Is it like substantially increasing or over the long run? What about STOs? Are they already there or will they come? And if so, when? So what's your general perspective on where we are standing in regards to the current markets, assets, top assets out there, infrastructure, which is happening and so on? Maybe everybody quickly provides his perspective on what's happening currently. Who wants to start?
I'm happy to start.
Okay, thanks.
Yeah. So, you know, in a lot of these panels, everyone wants to know like where we think we are in the market as in, you know, price predictions. I'm sure that's not what we're talking about here. Though, of course, I do think that I would say we are in a, quote, bull market in that there's increasing interest across the space, right? What I've been getting asked in many of these discussions over the last 3 years that I've been in the space is, when are the institutions coming? And we always hear these different waves of like, they're coming and then they're slowing down, and the market reacts when we see big banks making steps to enter, and then slows down when they realize that banks understand that fundamentally this is a very different asset class, of course, than any other one, right? And in the sense that these are their assets. The protection of the said private key, the protection of these assets make transactions irreversible. And in the event that funds are lost or stolen, they're gone. So imagine that you're sitting at a big bank and you're the MD and you're saying, hey, I think we have a good idea for us to start offering some custody for Bitcoin. And they say, hey, how much can you make? And we think we can make, I don't know, 10, 20, 30, $40 million a year. And what happens if you lose it? We lose billions. Next opportunity. What are we thinking about? And so that's how this has been literally over years. So I think that we are seeing now banks are looking at two potential avenues for their business model. One is in native custody of crypto, and the other, of course, is in the tokenization of assets. There are three things that they need. They need to make sure that the security of said assets, is, so to speak, kosher. They need to make sure that the technology, which is a lot of what we all talk about here, is scalable to meet the needs of these banks. Because remember, in crypto, this started for a couple of guys in a garage that ended up creating exchanges. These were 3 people at a firm. This is not the 50, 100 people that are required in operations at a big bank. And so making sure that the technology is scalable. And then the third, of course, is the regulatory side. And we are seeing pockets of regulatory clarity that's coming out. Things like the OCC announcement last week, which are all very positive for the industry. We're not there yet, but that's why I think we, certainly from Curv, we are now seeing increased conversations with these traditional firms saying like, okay, regulatory is looking, towards the right direction. From appetite from like a business model, we're seeing clients that are interested. Now, how do we make sure that the technology is matching that?
Okay, if you talk about movements like as you have expressed, do you mainly have the US in mind, or European jurisdictions such as Switzerland?
Yeah, so no, we have been seeing it pretty globally. I mean, actually, our first regulated custodians that have come on as clients have been actually in the German market. So, we've seen that, and then after that, we had some clients who were in the U.S. who then became regulated and evolved into that market as well. But no, I would say that the appetite is actually global.
Okay, interesting. Who wants to basically add a couple of things on these market?
Sure, I'm happy to jump in. So, I mean, I would concur with a lot of what Josh said. Basically, I think what we saw at METACO basically was in 2018, 2019. I think there was really the early adopters. It was all about crypto. I mean, all the business cases were, in fact, we never really had to pitch the product per se or pitch a business case. It was all about these banks want to differentiate themselves by being a custodian for what's an existing asset class. And I think 2020, we've really seen that interest really broaden. I mean, we've seen this gone to mainstream. I think you've got some of the demand side, whether it's Paul Tudor Jones saying they're going to invest in this asset class. I mean, I think we're on the edge degree. I think it wouldn't be an exaggeration to say 2021 could be similar to how we saw, retail FOMO in 2017. I think there's a risk that institutions start trying to play catch up, and 2021 could really be an institutional FOMO period. Similar story around the business case. The business case historically has been crypto. We see actually quite a dramatic shift, I'd say, the last few months around tokenization. And your question is, when this reality? Well, I think it's still, from where I'm sitting, it's still not clear, because there is no real, there's a lot of experiments in this space, a lot of bespoke initiatives. We've got some infrastructure providers, whether it's SIX or Deutsche Börse, looking to launch, established marketplaces, but these aren't really out there yet. I mean, there's a lot, and everyone's trying to build kind of bespoke one-off tokenization efforts, and secondary markets are a bit hit and miss. But I think clearly, even those that build a business case around crypto saw the bigger opportunity in the tokenization space. So it's a question of time, but I think the business case is a bit more difficult at the moment to make around tokenization, but clearly it's a huge opportunity when it comes. But the biggest obstacle to either of those has been regulatory. So echoing what Josh said, I think those jurisdictions where Germany, I think particularly, we've seen a lot of interest because the regulator BaFin has been so progressive. FINMA was one of the first to move in that space. We've seen Asia, Singapore, MAS in Singapore, obviously similarly championing this asset class and basically banks to build. So in all those jurisdictions, when we've seen that, we've had very good traction with the banks. I mean, they don't like regulatory, let's say, uncertainty. It's cost them a lot in regulatory fines in the past. They don't want to do that same in this asset class, which historically, as far as they're concerned, has had some reputational issues. Now, I think those are largely going away, and I think OCC, if that has opened the door in the US. So that, I think banks play in herd mentality. They like to go where others have tried before because there's safety in masses. And I think that's what we're starting to see, basically a growing momentum from institutions building infrastructure to support this.
Okay, excellent. So it's fascinating that the market appears to be so dynamic such that you have time for this webinar, right? Because you must have a lot of work to do in your mailbox. Maybe not yet, maybe that comes the next year. Okay, anybody wants to add something, maybe?
I can jump quickly.
Lior?
Just jump quickly here. I couldn't agree more with the guys here. I think that it's clear for all of us that the economic wealth is becoming digitalized. There are a lot of good reasons why to use blockchain rather than other databases. And I think that the banks right now recognize the digitalization and the blockchain-based assets economic as a new source of revenue. It's indeed started in Germany and the FINMA in Switzerland, Germany at the end of last year. And right now with the new OCC notice, I think that this is something that's making a lot of other countries joining in. We saw the same publication in Russia, and it looks like the European market going to this direction as well. And as we understand the market, we think that each of those banks that today offering different financial services on fiat money, the intention is to offer the same thing over blockchain-based assets. So it seems like 2021 going to be a very interesting year for all of those banks.
Okay, yeah, so we are mostly having consensus on this regard. Okay, and last point, would you like to add something?
Maybe from my side, just 2 points, right? What I see is the discussion went a little bit away from the pure business case, right? More into the strategic dimension that the banks really came to the conclusion that they need to build up experience, knowledge, and capabilities around cryptocurrencies and digital assets, and that banks mainly see cryptocurrencies as a first building step towards digital assets. That's the first point I would like to make. The second point is also really the importance about these first movers, right? The first movers have shown to the more traditional financial institution that all the regulatory hassles are solvable. It's really doable also in a regulated manner. And that's now really creating some momentum that the wider financial service industry can move on.
Okay, but also I now have basically analyzed what you have saying, and mostly you said that basically crypto assets are the entry stage for banks, right? To then afterwards join the tokenization market once it's arising. Now, very quickly, the question, maybe not everybody needs to answer, but can you do security tokens and tokenization business without previously having dealt with crypto assets? Is there a kind of pretty clear sequence that you have to experiment with crypto assets first to then move on to other kinds of digital assets?
I guess there's not a hard dependency behind, right? But it really helps. In my point of view, from a technical standpoint, cryptocurrencies are much harder to do, right? Also from a regulatory standpoint. From a legal standpoint, then it's getting a little bit trickier in tokenized assets because you have to wrap all these legal requirements and regulation into smart contracts. So that it's a little bit a different play. But I mean, you can benefit a lot of doing it in crypto first.
I mean, I just add to that. I think it's essential to understand the crypto space as well. I mean, if you want to get into the tokenization space, I don't think it's anywhere clear that tokenization will necessarily happen only on permission chains. I mean, I think there's a lot of corporate interest in permission chains, the same way there was in intranet versus internet. But I think if you look across that space, there's still no emerging standard. There's a lot of big players in this space. There's a lot of big initiatives, but I don't think there's an industry-wide standard. You know, I mean, so but we have emerging standards in the public space, and potentially a lot more investment in terms of you know, developers' eyeballs and basically research going into improving those standards. So I think the onus is on the firm to look at both spaces, to understand both spaces, because it's still very early days in the space, and you don't know which way it'll go.
Yeah, interesting. So if I would have the chance to look into your business models, then I would see tokenization and digital assets like as the future markets, the future clients you want to serve. And right now, everybody probably tries to get in touch with banks or other service providers, exchanges, who are trying to be like operating in the crypto asset area. So is this assumption wrong, right? Because there shouldn't be any larger tokenization business or security tokens right now at this point of time, not yet. Would you agree?
I would agree. We are still in the POC phase on digital assets, right? We see first production market offerings on the cryptocurrency space. That's also why we have chosen the strategy from a Custodigit perspective, really start with cryptocurrency, learn what it means to operate such a platform in a regulated environment. And as soon as the market is gaining steam on the digital assets, then with partners together go really into production system also on the digital asset space.
Okay.
Yeah, and then with that, you know, without I guess sharing too much on the client side, I would say like we have definitely seen early movers of clients who have tokenized traditional securities on public blockchains. So we were pretty vocal at the end of last year of our partnership with Franklin Templeton, who, again, this part at least is public because they did have to file all the registration statements, but they did tokenize a money market fund, a traditional security on a public blockchain, and of course they used us then as the infrastructure to protect those transactions. So I do think that, you know, just to reiterate what the other ones have said, that like the first move is of course going to be across the public chains. We are seeing first movers on tokenization using those as use cases, and yeah, I think that's the evolution that we'll eventually see towards a larger scale, especially with permission chains.
Okay,
I would add something on the technical perspective, if it's okay. I think that eventually those institutions should start with the public blockchain. I think that eventually they find blockchain as complicated technology, and the public blockchain are the one that actually decentralize and actually represent what true blockchain is. And I think that they should start with that. They should learn how it works. They should learn the benefit from that. And pending that, they may consider making some changes in order to use the permission blockchain if they have a good reason for that. We are in GK8 clearly recognize that the first banks that move into this space globally, they are trying to start with cryptocurrencies, of course, as long as the regulation approves it.
Okay, perfect. Sounds good. So you have a quite international view. I have one question noted here concerning the legislation. You said that Asia, Switzerland and Germany, they are partly quite progressive, if I got you right? What's going on in the, let's call it the legacy financial places such as London, Luxembourg, New York, and so on? Are they just larger and therefore maybe a little bit slower, or are they missing the train? Especially Luxembourg is thrilling because hardly anything is happening there, according to my knowledge, but I might be wrong.
I mean, personally, I think it's a combination of both. I think they're missing the train, and I think in the case, if you look at the U.S., it's a very fragmented environment. I mean, OCC is one of a few regulators, right? You've got the Federal Reserve, you basically have FDIC. I mean, and you've got all the state regulators. So it's a very fragmented as well environment. So the good thing about someone like the OCC opening the door, as Josh said a couple of weeks ago, is they regulate, 800 banks, roughly 300 thrifts or savings and loans companies and a number of the trusts. So this is kind of, and of those, the big boys are in there. So JP Morgan's there, Citibank's there, Bank of America, State Street. So you have those that are the big global firms, and those to a degree will drive initiative in other jurisdictions. So How that's come, I don't, it's, you know, it's obviously tough to say what's driven the regulator, but I imagine some of it is looking at what's going on in these other markets and some lobbying behind the scenes that these banks, that the main, as you say, legacy firms in the financial system are being a little bit left behind. I mean, Europe's been very innovative. I mean, Germany, I mean, it's completely different than the US right now. Talk about POCs, at least the large firms talk about POCs, but they have no clear vision about when that goes productive. And productive is more around things that are currently regulated, like security tokens, which, as we just said, are a bit aspirational. So it's the OCC and regulators opening the door in these jurisdictions and providing a clear roadmap really creates a night and day environment, basically. Okay, Lior, you also are expert on what's happening here in the American market. Are you expecting the US to become the global leader in crypto custody based on what's happening in the US? But maybe you first quickly explain what American OCC did. I think that would be good.
So yeah, I think as I said before, I believe that eventually the American regulation, you know, everyone eventually following the Americans, and this was after the BaFin announcement late last year, one of the strongest messages that the regulation globally bring into the market. And I believe that this is something that's going to make the other countries doing the same. And as I mentioned before, the Russians took the same decision. It looks like it's going to the right direction also in Europe. I think that the American banks are going to be the leaders. I think that at this point they don't really have something that they can start with, and this is why I believe that they should use companies that are providing a full end-to-end solution, so they can start offer that. Eventually, there is a lack of technology understanding. They need to move quickly. They have a race to be the first to the market. This is why I believe they need a full end-to-end solution that can meet their technology needs in regarding to the security aspects, regarding to meeting the compliance and controls needs according to the regulation. So they should adopt things quickly. And I think that they even will not do a traditional POC with the RFIs and RFPs, but maybe going directly to start and working with something thanks to that. This is something that we do see in the market. Okay. But let's talk about the precise solutions which are in the market there. Maybe Seamus, a question for you. Given the wide range of solutions and implementation options, such as hardware-based as custody solutions, multi-signature, MPCs, on-premise, cloud, managed hosting, and so on, would you say that there is basically one size which fits all needs? Or do you have to have like multiple products in place to then serve the market based on company size, assets under management, value chain position, and so on?
Yeah, I mean, I think the simple answer is there's no one size fits all in the institutional market. I mean, we as a company, as I mentioned earlier, we're a software company, but we work with hardware-based security. And our focus has really been large tier one financial institutions, banks, exchanges. And you know, I think for them, it's not so much that we proselytize that hardware security is the best. It's more that that's what they want. That's what they understand. They've known that for 10, 20 years. And when you're looking at like a organization that's putting trillions of dollars through their systems a day in the traditional assets, they want to work with their security experts want to work with infrastructure they understand and trust. So I would say we've had a very good solution for markets like that. I mean, I think other areas, they're much more comfortable in moving with cloud-based multi-sig or obviously MPCs. I think it's getting great traction in a lot of ways, provides a lot of flexibility. I think all of these solutions, I think, have different niches, different areas where they can get traction. For example, I mean, given our solutions also on-premise, that doesn't fit with everybody's needs. It takes a certain technical knowledge to know how to manage that stack. And I'd say in addition to, you know, when you look at basically business cases and basically regulatory areas, the other areas, basically managing the technology stack is not trivial. So, I mean, that's one thing we're looking to address, and we'll launch a number of other services, both in kind of a no hardware solution and basically so cloud-based no hardware solution, a managed service. These are all in the pipeline for precisely this reason, because we're very strong with tier one institutions, but that doesn't work for everybody. The solution they're looking for is something that's much lighter touch, but provides the same sort of security.
Okay. Yeah, maybe Josh, let's follow up on this question. Why should banks actually take so much care about the underlying key management technology? Why is it so important? Is there a path dependency or a vendor lock-in? So what would you recommend here?
Yeah, sure. No, I think the Seamus said it very well, which is there's no one size that fits all. You know, they should take all of our technology. No, but the reality is, you know, I think that for clients who, especially these, you know, take the banks, you know, like they are coming into this space new. They don't have a deep understanding of the nuances of crypto. Like you said, like they're coming in from the infrastructure that they're already familiar with for other asset classes. And so they need to get educated really on two aspects. They need to be looking at all the options in the market in terms of like, what's the underlying security model that's being utilized for key management? And then they have to be looking at the actual deployment of the technology itself. Like you mentioned, is it on or off-prem? How is it scalable? How are all of their users utilizing it? Are they using UI, API? Can they do mobile phones? Like, well, like to think about how it will be deployed within their organization and especially interacting with their clients. So those are really two different aspects. Within the key management side, of course, from our perspective, you know, we've seen a tremendous evolution over the years in terms of security for digital assets. It has moved tremendously from that one single private key that's kept online, which could be completely compromised. And we've seen lots of iterations over time. We've seen cold storage, we've seen sharding of that key, where now there's not one single point of failure that's held in multiple places. We've seen things like multi-sig, and now, of course, we've seen things like multi-party computation, where the actual creation of that private key is eliminated completely. Is it, you know, how should clients be thinking about it? Okay, so, you know, if a client is using, let's say, they need to understand the positives and drawbacks of each. So if, let's say, they're using something like Ethereum, right? Not every asset class supports each of the key management solutions in the same way. Multi-sig, for example, is natively supported by Bitcoin, but is not natively supported across Ethereum. Ethereum, both for like, for Ethereum itself, for everything on Ethereum, the entire DeFi movement, and even tokenized securities that are right now being done on Ethereum, all of that is not natively supporting multi-sig, and so people are using smart contracts. One of the drawbacks of using smart contracts to mimic the use of a multi-sig solution is that it incurs very high gas fees, and as we know, gas fees are now to run contracts on Ethereum are now at the highest they've ever been, and it's almost becoming to a point where it's cost prohibitive. And so if a client is looking at building something on Ethereum, they certainly would probably say, hey, this would be a reason to not look at something like multi-sig. Let me look at a different security model, perhaps like MPC. But again, there is no one size fits all. And I think these are the types of questions that we go through when talking with clients. You know, how many users do you have and what kind of access to the keys do they have? Are you concerned if, let's say, a user at your firm leaves and then had a piece of the actual underlying key material in an example like a multi-sig, whereas on MPC, where it's completely off-chain, and we have this concept of security hygiene, where these cryptographic shares are constantly rotating. These are the types of things that, again, it's not to necessarily pigeonhole every client into one solution, but there are questions that these banks should be asking, that these firms should be asking, that will kind of lead them down the road of what's the right solution for them.
Okay, excellent. That was a very, very holistic answer. So let's talk about barriers to implementation or barriers to adoption. Maybe Peter, do you see what major barriers do you see with banks who basically want to adopt this technology, but maybe they are just stuck and are not moving? Is it a budget question? Is it an education question? Is it an intransparency question, because there are a couple of custody providers out there? What's your experiences?
So our experience is actually regulation, right? That's an important topic where they need to get experience, education, that you can actually solve that also in the cryptocurrency digital asset space. And the second one is, and that's a little bit a differentiation regarding the discussion just before, is on the processes itself. how you actually are doing settlement, how you are connecting to liquidity pool, how does then settlement look like. It's all those processes they already know, but they have to be adapted to the special circumstances of digital assets or cryptocurrencies. And the banks need to figure out how they can actually solve those process questions. And that's also the focus of Custodigit, right? We are not focusing that much on the safekeeping of the private keys. For that, we have companies like METACO, Curv, Geeky8, but we are really building then the process layer on top of that. So from my point of view, the barriers are regulation, meaning how to actually fulfill those requirements you have from the regulator and how you do design the processes around and build that in a platform.
Okay. Who wants to add something on the biggest barriers for traditional players?
Maybe
I would like to jump in.
Yeah, please. We do the entire round.
Thank you so much. Just want to focus specifically, first of all, on security to add of what Josh just said before. I think that this is the biggest obstacle, and I mean, regulation is definitely something that you can't control, but the security and the product are definitely something that you can control. And I can share personally, I used to write code, and I know that when you do write code, there are bugs. And when there are bugs, hackers that can exploit the vulnerabilities that they are creating, it's something that can lead for a lot of money that can be stolen. And if we take a look about the other financial institutions, which are not the banks that at the past year joining this market, we saw that billions of dollars were stolen. It was 1 billion in 2018, 4.6 in 2019, and it's predicted to be even worse as the markets keep going. Now, we see that hackers are willing to invest millions to steal billions, especially the state-level hackers. And we understand that banks today can choose whether they can take some kind of cold wallets or some kind of hot wallets. Now, hot wallets, even if they are MPC-based, we recognize that hacker can invest, let's say, 1 million in average to compromise one internet-connected computer. In order to compromise MPC, all of what you need to do is to invest a few millions in order to take control on a few different computers. And again, potentially still billions. Now, on the other end, we recognize that in the market, there are solutions that claim to be cold while they're not really cold. As there is some point, the point where you want to create and send the transaction to the blockchain, where the other wallet should get input from the internet. Now, this is exactly the point where hackers can take control and can exploit the vulnerabilities that created by the code. Now, we believe that the only way to actually prevent such kind of hacking event is only prevent hackers with the ability to take control on those local environments. Now, we believe that the only way to prevent those hacking events is only not being connected to the internet at all. And this is exactly that we are in GKA took this approach of being completely offline, using only outbound unidirectional communication. So this way, banks can be 100% safe from cybersecurity attacks. And I'm staying behind every word that I'm saying right now. Now, of course, in addition to that, in order to create the needed trust among the banks once they want to offer crypto services for their clients, something that is very much important is also the insurance. Eventually, of course, if you got the right technology, you should feel comfortable. But as long as you have insurance, you can make your clients feel very comfortable to work specifically with you. I'm very proud to say that we provide the highest insurance in the market of $500 million, which is not pooled, but actually per bank that decide to use our on-premise solution to manage these blockchain-based assets. And we believe that this is something that can make banks feel very comfortable to start and quickly adopt financial services on blockchain-based assets.
If I just jump in on a slightly different angle about barriers. I mean, I think assuming the regulations in line and the bank is comfortable moving, I think always the decision is, should they, given we've mentioned it's a fairly complicated technology or complicated space and fast moving space. There's always the question, should they externalize this to a custodian or basically work with the technology, build it, or basically work with a trusted technology partner. And one of the things we've discovered feedback from our clients, I mean, some of the very large tier 1 banks had quite long projects working with some of the digitally native, let's say, exchange custodians in the market to try to partner with them. But the problem really came down to the governance and basically what basically workflows they could implement. I mean, the obvious thing is banks are highly regulated. They're large, complicated organizations. They've got very specific workflows around, you know, how transactions are done in traditional assets, you know, operational controls, risk controls, what have you, AML processes. You know, it's a long list. It's, you know, everything about risk mitigation. And, you know, when you try to fit that into an exchange that has a hot wallet and, you know, two of three, and you can change that to 2 of 6 signatures, it just doesn't cut it in terms of their operational processes. So supporting business logic is critical. And we've seen a lot of those kind of large banks that started that way decide they need a technology partner. So that's one of the ways we've seen. I think the same thing happens. The smaller banks we've seen in Germany want to partner with a custodian because it's an easy start. There's no CapEx. They can start working with a third-party custodian. Typically, they have fairly high fees, but I think, you know, we're all here because I think the tokenization or the digital space is the way of the future for financial markets. So I find it long-term. I find it's, unless these firms grow very dramatically, I think you're externalizing what could be core assets to effectively a startup, to a lightly capitalized organization. So I think there's long-term, it's great for experiments to get the ball rolling, but I still think basically at banks, when they look again at what the potential downside risks are longer term, I think they really need to find a trusted technology partner that doesn't also work as a, let's say, a service provider, doesn't try to compete with them in some way. So I think there's the banks need to think about delineating, you know, what the risks are from technology versus competition versus outsourcing this. And also being able to support the workflows. As Peter said, basically, business processes are critical to banks. And you need basically a layer, which precisely we've recently launched what we call our programmable governance. So you have basically end-to-end cryptographic, secure, dynamic, risk-based governance. I mean, a long expression, but the long and short of it is you can have holistic sort of framework by client, and it can be dynamic, effectively changes based on what's going through the book. So it's much easier to maintain. You can basically build any workflow that the bank may have, whether it includes bots or people, AML processes, you know, escalating to manual to automated checks. It can all be supported. And we've seen that as a real differentiator in the market.
There's an interesting follow-on question. So basically, what is the right strategy for a bank? You have smaller banks, larger banks, you have exchanges, you have international banks. In Germany, it's even more complicated with these, let's call it banking networks, you know, like the Sparkassen and so on. So what's the right strategy? An external custodian, build it yourself, liaising with a technology partner, doing self-custody. So because apparently, I think this is true, you all are one of the senior blockchain custody companies out there. So probably you all you all basically are the right partners for larger banks, right? So, and still you don't have one and the same solution. So what do you think is for a bank the best tactic or the best strategy? And what characteristics does a bank has to have to basically identify a specific custody solution with a license, without a license? And there are so many parameters. Seamus just started outlining a couple of them. Who wants to add a couple of models here?
Yeah, I'll jump in. So first of all, I wholeheartedly agree with everything that Seamus just said. And I think even, you know, this came up, we wrote a piece about this, like Seamus referenced after the OCC announcement, talking about like now what are banks thinking about doing? So they have two major options, right? They can either sub-custody with one of the existing custodians out there or build it themselves. Yeah, there's a big barrier to start thinking about from a technology gap and a learning gap, as well as from an upfront infrastructure cost if they build it themselves. But if they use an external sub-custody solution, they actually run the risk of using someone who's going to just go ahead and steal their business or compete with them. That's the business that these custodians are in. And so I just don't think, you know, and there obviously have been either exchanges that became custodians or technology providers that became custodians that created a conflict of interest for those clients and start using them because they know that on the other side, they're going to go ahead and compete. I think what's unique about the players here on the panel is, like you mentioned, we're not regulated custodians. We're not looking to be custodians. We're actually looking to partner with our clients so that they can bring those solutions to market. Now, how should banks be looking at this? So like you said before, there's that aspect of what the key management, and the other piece is the deployment. So each bank has to start thinking about, what are those pieces of deployment? Who's holding keys? Who needs to not necessarily be able to sign, but have to authorize transactions? What are the, how are we holding client funds in different omnibus structures or per client wallets? How easy do we need to keep those? Are we in a jurisdiction where, from a regulatory perspective, some of our assets or all of our assets need to be held in cold storage or air gap, like Lior had mentioned? And am I using an infrastructure where I can keep funds online in warm wallets or completely air gap? What are the ways that that I, as a user at that bank, are interacting? Is there a deployment model where I have a UI, a very easy way for me to move funds? Is there a robust APIs for me to build this all programmatically? Can my users, my operations team who's sitting at home, by the way, right now in COVID, most operations teams are sitting at home. So is there an easy way for me to be able to have the same level of security and operational seamless, procedures when everyone is remote? These are the insurance Lior had mentioned, right? These are the kinds of questions everyone should be thinking about. And then, of course, also KYC and AML. So, there have been, as we know, many AML providers in the space. This is another interesting one I think about, that AML is one of the pieces that allow firms in the space to represent themselves as being like this is not just the old crypto market of like nefarious activities, but like we're actually doing things and keeping things kosher. But what most people do is they check the data, they check the information completely separate from when they actually send transactions. Those two things should be completely connected. There should be enforceable policies, enforceable compliance, which is one of the things that we actually announced recently at Curv, where a client, for example, can use one of the AML providers that are out there and actually build into their policy engine that a transaction will never be sent if it violates a policy. Now compliance firms can go to regulators and say, hey, look, we now have technology. It's different. Everything has evolved. We have technology that can actually bring this market to a level where regulators are more comfortable giving guidance. I know it's a lot, but these are the types of things that banks should all be looking across all these different pieces.
May I jump in for a second? I very much agree with Josh. Eventually, banks today, when they offer financial services on fiat money, they don't use other banks in order to do it. Now, I think that the blockchain market, as we all speaking right now, is rapidly growing, and there is no chance that the internal employees of the bank will keep up to date with the most updated assets out there and with the most updated functionalities that out there. They should bring the companies that focus on creating such a solution in order to do it. Now, once you have your own custody solution in place, this is something that allows you to control your own private keys. It's something that allows you to build your own strategy as a bank. And once you have your own solution, once you have a full end-to-end solution that's combining the vault part, that's combining the high-frequency transaction part, that's combining the endpoint parts, where you can build your own business logics as bank according to your strategy on top of that, you're ready to go and you'll be able to win in this race of the banks that's looking to have to be the first in the market and to have this new source of revenues. And of course, we are in GK8 providing the full end-to-end solution. It's not only the vault part, but also the MPC part for high-frequency transactions and the endpoint. So it's actually something that banks can start operating right away and keep up to date with the most recent technologies out there.
That's also the perspective of Custodigit, right? We see that the banks are in two different strategic directions they can take, either build the whole stack on their own or go to a regulated custodian. And Custodigit actually wants to provide the middle way, right? We are providing the bank in a box for digital assets in a software as a service. So a bank doesn't have the huge upfront investments they normally have with the make approach. And on the other hand, they also have the business case because they don't have to use a regulated custodian. And thanks to a managed service, they actually can do it quite easily without doing all the research and the experience we have done so far. So our goal is really to provide them a jump start to go into the digital assets. And that we see as the middle way, which is not a one size fits all, but it could be for a certain segment an interesting strategic path to go.
Okay. Anybody wants to add something on these remarks?
Just a very short comment. I mean, this decision about externalizing or basically building your own, I think we're pretty much aligned. And I think one thing that we noticed that firms are missing is custody isn't necessarily the end game. It's a foundational infrastructure for your digital stack. I mean, if you don't have this, nothing's safe, basically. But I think the point is, look at traditional assets. The fees custodians charge are fractions of basis points. This is the way it's going to go in digital assets. It's just a question of time. So if you externalize it, you don't have that flexibility. And ultimately, where you generate your business model longer term will not be from the custody fees. It'll be other services you build around this. So what's critical then is probably to own that, or to have possibly the halfway solution, as Philipp's mentioning. I think it's really externalizing that to custodian that's charging you 1% or 50 basis points. It's a non-starter longer term. And what you need is the foundational infrastructure. Maybe for an experiment, for POC, for a temporary validation, it makes sense. But I think most firms should really be thinking about owning this infrastructure, because you need it, and it's foundational, and it won't enable you to respond and build the way the stack is going to evolve over time.
Okay. Sometimes people are saying, including me, that there will be no bank in the future without custody. Would you agree?
No.
So what that's interesting, because what would a bank do in the future handling financial assets, but basically not doing custody, or might it basically source in the technology from somewhere, basically rather distance, for example, via core banking provider?
My personal view on the future is not every bank should build their own infrastructure, right? There will be, and that's what we are seeing already in the market, there will be some solution providers, right, which are providing it as a software as a service, for example, and really take care of the underlying technology stack. Like we see it for core banking, you have certain providers who are providing that to the banks as a platform service. For some banks, it makes sense to really build the whole stack, not for every bank, I would say.
Okay, so to rephrase the question, what I meant is, okay, there are banks which might have the custody solution quite distant to them. They are not building it themselves, but there will not, okay, another proposal, will there be a bank without DLT in the future? In case a bank tries to really stick away from DLT for whatever reason, maybe they don't like it, maybe they have the wrong personnel, whatever, will there be banks without DLT, or does it make sense to stay away from this area? That's basically the other question turning it around.
I think that bank will not be able anywhere to ignore blockchain or DLT initiatives starting, let's say, next year. Banks should recognize these blockchain-based assets and blockchain initiatives as new source of revenues. I think the ones that will stay behind, especially the giant ones, will lose the chance to earn a lot of money by this new these new blockchain-based asset classes, which, as we said before, are not longer only cryptocurrencies, but securities, stocks, real estate, the derivative market that's being more and more based on blockchain. And I personally believe that each of the banks should at least adopt one financial services that should be based on blockchain-based assets. Okay,
so that would be a clear guess. Somebody wants to add a couple of points here?
I agree. I think that the banks can't afford to not. look what's happening even from like the fintech players that are starting to take some client base away from the banks, right? Firms like even like Square, who have been able to build really interesting businesses leveraging crypto, and banks are, you know, banks are recognizing this and they're seeing what's happening. And so again, whether it's to start in order to just keep their clients captive and be able to retain their clients, or just like Lior said, to be able to stay relevant as the technology continues to evolve, I think they can't afford to not have a strategy.
I mean, there's competitive pressure, right? Do you want to leave your money at 0 rates for the bank, or do you want to put it, you know, buy a stable coin and earn 8.6% at BlockFi? I mean, this, you know, there's some pretty significant economic motives to drive business away from banks or to encourage banks to get involved.
Okay, good point. Last question coming here from the panel. Nobody talked about the technological challenge of scalability so far. I know that that's a different discussion because scalability is about transaction throughput. We are talking about private key storage, but still, do you see scalability being a barrier to a quicker adoption, to basically banks now driving this kind of development?
I would jump in and say that when it comes to public blockchain, this problem become not as significant one as in permission blockchain. In the public blockchain, the amount of transactions that actually can be inserted to the blockchain is limited. So that's not really a big deal. But when it comes to the permission blockchain, this is the place where it could be a big deal. Today, there are multiple solutions that can solve that, and there are major ones, especially the more secure ones that don't. Most of the MPC solutions, for example, that we research couldn't work with more than a very few signing per second. And this is a very challenging thing. I can share that this is something that we are in GK8 put a lot of efforts to solve with a solution that can make thousands of signing per second. So even if it's about permission blockchain that should take place for different use cases, this is something that can be solvable. But in the public blockchain, it's not as painful as in the permission one.
Mm-hmm. Absolutely. That was technology expertise at its best. Somebody wants to add something. Could we adopt this technology faster in case this scalability discussion doesn't arise all the time?
From my point of view, it's not really about the transaction output, which is hindering adoption right now. I would more say it's the question about the duration, right, of the transaction till we have finality. If you are having a look on the finality with common sense in the market in public blockchain, it's in, for example, in Bitcoin, it's around the 6 blocks. That's an hour pretty much, right, till a transaction reaches finality. And I guess that's where we have to find solution around other than having everything off chain.
Okay, perfect. I think we are now close to the end. Maybe anybody does a quick closing remark, for example, on the question which Seamus pointed out in the very beginning. Do we see, like, let's call it a bull market in 2021 with people driving this? Why? Because they are now building the infrastructure to have on-ramps for next year, right? That's basically what's happening on a supply and demand logic here. In case you agree or disagree, maybe everybody makes a final closing statement on this regard. Would this be okay?
Should I kick it off then? Yeah, I mean, I would just reiterate what I said earlier. I think 2021 is going to be the year of institutional FOMO. You're seeing basically, whether it's at the corporate level, like MicroStrategy allocating to Bitcoin as part of their treasury management, or, you know, kind of a legendary hedge fund manager like Paul Tudor Jones invest in this asset class. I think, you know, if we do see any sort of price traction, you get massive outperformance by some of these players. You already have large players like JP Morgan banking, like Coinbase and Gemini. I mean, this is, we're at a tipping point, basically. I think one of the catalysts would be a higher price. I mean, it's a bit recursive, but I think higher price, we could really see this market on the institutional side get very, very hot.
Okay, who's next?
I agree. I think we're in we're at the beginning of a bull market. What's unique about the people you have on this panel is, I wouldn't call it inside information, but it is true that we sort of see the early adopters well before they come to the market, because the first conversations that they have to have is around their technology solution well before they're public about having a strategy to go to market. So I can certainly say, like, anecdotally, that there is that 2021 should be a very good good sign of more entrance into the space. The FOMO, as Seamus had mentioned, I think there are a lot of people that are looking at this space right now.
Okay, so apparently, but you're still working at your company. You haven't stopped working and turning like any cent you have into Bitcoin, right? You haven't done this yet. Maybe you have, I don't know. That's not the topic of this talk. Okay.
Sure, I'd love to talk Bitcoin, but that's another discussion. Yeah.
We do this next time. That's nice. Okay. Any other closing remark from you, Lior or Peter?
Yes, as you can tell, I definitely agree with the guys. We recognize from global banks that more actively, since especially the less regulation and notices, are looking for scheduling calls to learn more. They're looking to read more the white paper. And along with that, we see a lot of different central bank digital currency projects that also making a lot of noise. So I clearly believe that in 2021, we're about to see a huge boom in the market. And I'm very much excited and looking forward to be there and see how it's going to happen.
I go in a similar direction, right? I see that 2021 institutional grade market infrastructure should be ready. Meaning also with an institutional market infrastructure, the institutional money will come in, which hopefully will lead to a bull market.
That was a very nice closing word. Thank you all. I think that was a great discussion. You are partly competitors, but I think you're all agreeing on the same industry dynamics. That's fascinating to hear. Nobody thinks there is a downturn happening. And therefore, I really enjoyed it. I also learned a lot. And thanks for being here. And thanks for Jan organizing this. Thanks.
Thanks.
Thank you for having us.
You're welcome. Thanks for the insights, and see you next time.
Great.
Thank you, guys.
See you. Bye.
Bye. Have a good afternoon.
Bye. Thank you.